You're listening to Capital Topics, episode number 57. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll review the powerful advantages of building your portfolio with total market ETFs. And for our next topic, we will discuss Canada's tax system and try to answer the following question. Do high earners pay their fair share of taxes? Enjoy! Good morning, James. How are you today?
I'm very good, François, and how are you?
I'm good, thank you. So I'll start. In our first subject today, we will address why we prefer using total market ETFs or mutual funds to build our portfolios rather than other investment solutions that replicate recognized commercial benchmarks such as the S&P 500 index for US equity or the S&P TSX 60 index here in Canada and other large benchmarks.
Well, François, yes, we often highlight in our podcast and in our blogs that we build portfolios using broad-based ETFs and mutual funds. I believe we have never really delved into the details as to why we do this. So we're going to do that today. And so really what motivated us to tackle this topic is we recently had a really in-depth conversation with a new client who's very knowledgeable. And he really asked us why we were using a total market ETF for our U.S. equity exposure when really the S&P 500 is what most people like to think is the U.S. market.
Exactly, and we thought it was a good opportunity to prepare an update on the research on this topic. So we reached out to our colleague Raymond Curzero, which has been on the show with us before. He's a PWL senior researcher, and we asked him to look into this. So in late August, he published his finding in a paper entitled U.S. Total Market or S&P 500 ETF. This paper is available on the PWL website, and we will share the link with our listeners with this podcast.
So I would also like to note for our listeners that this paper focuses on the U.S. equity market, specifically the Vanguard U.S. Total Market Index ETF versus the S&P 500 Index ETF. So, François, what does the paper say?
Okay, so as you mentioned, James Raymond, as the title of his article suggests, looked at the question from a U.S. equity perspective only. He looked at the mechanics of the historical performance of the total market approach using a crisp U.S. total market index against the S&P 500 index.
Yeah, well, I'm assuming here most of our listeners may not be familiar with CRISP. And this is an acronym that stands for Center for Research and Security Prices, and it's affiliated with the University of Chicago Booth School of Business. So where, Gene Fama and other leading Nobel Prize-winning finance academics are based. The CRISP market indices are widely known and used by leading financial academics in their research because of the quality of its data. It's safe to say, however, that the CRISP market indices are really virtually unknown in the retail investing world.
Yeah, I think you're correct there, James. CRISP indices are not well known with most investors. On the other hand, the S&P 500 index or the Dow Jones Industrial Average are quoted daily in financial media. Therefore, they resonate a lot more with investors. However, what's interesting here is that the world's largest fund, the Vanguard U.S. Total Market Index, is a fund that we buy for our clients. It uses the CRISP U.S. Total Market as a benchmark.
That's interesting, François. But how does the CRISP U.S. Total Market Index compare with a more commercial index like the S&P 500?
Well, the big difference here is the number of stocks held in each one. The CRISP U.S. Total Market holds over 3,800 U.S. stocks, which represent roughly 99.5% of the market capitalization of the U.S. stocks. It holds not only large cap securities, but also mid and small cap stocks. By comparison, the S&P 500 index holds roughly 500 U.S. large cap stocks, representing about 80% of the U.S. market capitalization. Although it's the most popular benchmark for U.S. stocks, it does not hold mid and small cap stocks.
Yeah, so the advantage really, as I see it, François, is that using the CRSP U.S. Total Market Index compared to the S&P 500 index is that you're adding another 3,300 stocks to your
Yeah.
portfolio
Yeah.
with this one ETF, and this increases your diversification benefit as you gain exposure to the total U.S. stock market by close to 20 percentage points to 99.5% of the total U.S. publicly traded stock market.
Yeah, correct. You're effectively holding all the US stocks. You are adding a lot of companies to your portfolio, so broader diversification. And more importantly, as I said earlier, you're adding the mid and small cap stocks.
So what else does Raymond say in his paper?
While he covered the stock inclusion methodology for both indexes, he explained that the methodology for the CRSP index was rule-based and that stocks were added based on their weighted free float adjusted capitalization with little human intervention.
Well, that's a mouthful. Weighted free
Yeah, it
float
is.
capitalization. So what this really means is this methodology is a method of calculating the market cap of a stock by multiplying its price by the number of shares readily available in the market to be traded, and then ranking the stocks from the largest to the smallest.
Correct. And in comparison, he mentions that the stocks in the S&P 500 index are also weighted on a free float adjusted capitalization, but that eligibility for inclusion follows a two-step process. The first step is based on specific objective criteria that Raymond enumerates in his paper. But the second step, once the list of eligible stocks is established, an index committee selects the 500 securities. The problem with this, and I quote Raymond, this community-based step makes the S&P index similar to an actively managed index.
Well, isn't that interesting? Because everybody assumes that the S&P 500 is, quote, a passive index.
Mm-hmm. Correct.
Beyond that, François, what does the historical performance say?
Since the S&P 500 index was launched in March 1957, up to June 2023, the CRSP U.S. Total Market Index has slightly outperformed the S&P 500 index by a small margin, however, of 0.03%. The CRSP index returned 10.48% annualized, while the S&P 500 returned 10.45% also on an annualized basis. This outperformance came with a slightly higher volatility for the CRSP U.S. total market. Mid and small cap stocks, which are included in the CRSP U.S. total market index, exhibit higher volatility than the S&P 500 index, which generally only includes large cap stocks.
Okay, but despite this small difference in performance, François, what's important to understand here is that adding small cap stocks to your portfolio increases its expected return. Several academic research papers have produced evidence that historically, small cap stocks have delivered higher returns than large cap stocks.
That's correct, James. Based on research from Professor Fama and French, the small cap or size premium is even more compelling if you exclude from the portfolio small growth, low profitability stocks, which have historically failed to deliver the size premium. This idea of excluding small growth, low profitability stocks is one of the many advantages of using dimensional funds in our clients' portfolios. In all their equity funds, they exclude these stocks.
Well, what kind of size premium are we talking about here if you exclude these small growth, low profitability stocks?
Well, based on Dimensional's small cap indices, in the last 30 years ending August 31st, 2023, the small cap premium in Canada is 0.66%, so a bit less than 1%. This is not the holy grail, but if you look at other markets, for example, in the US, it was 1.42% on an annualized basis. In international developed countries, it was 186, also on an annualized basis. And in the emerging markets, it was a sizable 2.3% on an annualized basis. In the US, there's data going back a lot longer. For example, data going back 90 years shows that the small cap premium for that period was 2.23% on an annualized basis.
Wow, these premiums are huge. However, investors need to understand that small cap stocks will not outperform large cap stocks every month or even every year. May go very long periods where it underperforms, like we've seen recently with the mega caps driving large cap growth stocks much higher returns versus small cap. But
Correct.
there is no free lunch. Unless you stay invested for long periods of time to capture the expected size premium, you're not going to get it. François, what do you think of adding an S&P 400 index ETF for the mid-cap stocks and an S&P 600 index for the small-cap stocks to an S&P 500 index to build your portfolio, therefore simulating the broad market ETF? Mm-hmm. Does that make any sense?
Well, unless an investor plans to deviate from the U.S. total market, I would not go that route because that portfolio would require more trading to rebalance and keep the market-like allocation between the three size baskets. Furthermore, if you add up all these securities in these different three buckets, you're not even close to getting to the crisp U.S. total market index totals number of securities. It would also increase the cost, and it would likely be less tax efficient because of capital gains being triggered during the reconstitution of the index when stocks move from the small cap index to the mid cap index, or from the mid cap index to the large cap index.
For our listeners' benefit, the reconstitution of an index is by definition the process that involves sorting, adding, and removing stocks to ensure that an index reflects an up-to-date market capitalization and style. But for Canadian taxable residents, you are at risk that during these reconstitution events, that you will be attributed capital gains that will be taxed as ordinary income at your full top marginal tax rate. We learned this one the hard way, François, about 20 years ago with the S&P 600.
Mm-hmm. I would also add, James, that by holding the entire market with one ETF, you don't have to worry about what is called the reconstitution effect. This is when active traders or hedge funds trade ahead of the reconstitution date of an index to try to make a profit from the upcoming changes. They buy the additions and they sell the deletions before the indexers. Therefore, they push the prices up for the indexers on the additions and push the prices down on the deletions.
Yeah, and then when the indexers have adjusted their portfolios, the prices of these additions and deletions generally reverse, and that's when additions normally underperform and deletions outperform.
Yeah, totally. So to conclude, James, I believe that holding a total market ETF or mutual fund is the perfect holding for simplicity, broad diversification, and tax efficiency. Furthermore, as Raymond has highlighted in his conclusion based on research from the University of Arizona, and I quote, "At the margin, a small number of winning stock explains a long-term market performance. Therefore, in order to benefit, I prefer holding all the stocks to make sure I have all the winners in my portfolio. By including small caps and mid cap stocks, you're increasing the odds of holding the next large cap or mega cap stock winner." I will finish by quoting Raymond's paper again, and I quote, "The risk of missing out on the high return stocks was highlighted in 2020 when the S&P 500 Index Committee failed to include Tesla's shares in the index until December after the shares had risen 400%.
It's a great example, François.
Totally. I think that resumes it. Okay, James, for our main topic today, that's a real hot button issue for pretty much all Canadians. Everyone feels they pay too much tax. There's a general perception that the very wealthy can find ways to pay less than their fair share. Raising taxes on top income earners often proposed as a solution for generating a lot of extra revenue and at the same time reducing inequalities in Canada. So what do you have to share with us today, James?
Well, François, there is indeed a misconception that top earners are not paying their fair share of taxes. Our clients are among the very wealthy, and many qualify for the top 1% in terms of income, and certainly when you look at them based on assets. What we see is that they pay a lot of taxes when measured based on total average income tax rates, and also when measured in dollar amounts of tax paid to all levels of government. Canada's social safety net is a great achievement by successive generations in this country, provides health care, support for the poor and disabled, and pensions for senior citizens, among other critically important benefits that citizens of other countries can't count on.
Yeah. Of course, someone has to pay for all these services, and there's a big part of the reason why Canadians, especially higher income earners, pay a lot of the taxes.
So now most people support the idea that underpins our progressive personal income tax system. Those who earn more should pay more and at a higher rate as they earn more income.
James, to me, we really don't know the facts about who pays how much in Canada. What did you find in your research?
Well, that's the key. That's the key question. Who's paying what? And so I did some research to try and find some studies, and I'm going to highlight one of them in our podcast today. But all of them show that the top income earners collectively pay a disproportionate and growing share of both personal income taxes, and this is the really interesting part, total government taxes from all levels. Mm-hmm. So these studies also found, and this is very important, that raising taxes on top earners beyond a threshold comes along with considerable economic costs. Today, I will focus on the findings of a research bulletin from the nonpartisan Fraser Institute called Measuring Progressivity in Canada's Tax System 2023. And this was published very recently in August of this year. So,
so James, what does the paper say?
Well, what the Fraser Institute report basically does is answers the question about who pays what in Canada in terms of both personal income taxes and then in terms of total taxes that Canadians pay to the federal, to the provincial, and municipal governments. So the primary findings are, first, that high-income families already pay a disproportionately large share of all Canadian income taxes. Indeed, the evidence shows that the top 20% of income-earning families pay nearly two-thirds, or 61.9% to be precise, of the country's personal income taxes, and that more than half, 53.1%, of total taxes. In contrast, the second point is that the bottom 20% of income-earning families are estimated to pay only 0.7% of all federal and provincial personal income taxes and 2% of total taxes in Canada.
This makes total sense as it demonstrates that Canada's tax system is based on progressivity, where the shares of the taxes paid typically increase as income rises. What else did you find in the report, James?
Well, the Fraser Institute report goes on to state that raising taxes on high-income earners ignores the economic consequences of tax rate increases and the associated behavioral responses. And that's one of our favorite topics, that, investor behavior. Well, this is taxpayer behavior we're talking about here. And so when faced with higher taxes or new taxes, how do people behave? So, for instance, in response to a tax increase, many taxpayers will change their behavior in ways that reduce their taxable income through tax planning, avoidance, or go so far as tax evasion that results in governments raising a lot less revenue than they anticipated by these new policies.
Yeah, this really reminds me, James, of the American economist Arthur Laffer, who tried to prove with his work the relationship between tax rates and the resulting level of government tax revenue. It was called it's the famous Laffer curve that influenced Reaganomics in the early 1980s.
Yeah, so Arthur Laffer and actually other economists were never able to prove his theory. But it's totally intuitive that somewhere along the curve of higher tax rates on different levels of income is a tax rate that maximizes government tax revenue. And beyond that, government revenues will actually fall. So finding that maximum rate has been tricky exercise for all governments.
Yeah, the tax accountant Kim Moody was writing in the Financial Post recently, said it well. In my experience, personal behaviors significantly change when personal tax rates approach 50%. People will search for ways to lower their tax bill, especially when the perception is that there is not much value being provided when compared to the cost. James, we should share with our listeners a little recent history of tax rates in Canada.
Absolutely, François. So let's go back to 2015. At the time, marginal rates across Canada, the top ones in many provinces, were close to 48%. In Quebec, I think here it was 48.22. And this was important because psychologically, you're under that that 50%
Mm-hmm.
threshold
Yep.
that Kim Moody's talking about. And these are rates applied to ordinary income from employment, interest, other, foreign investment income, and other types of income. Canadian source dividends were taxed a bit less, but most importantly, capital gains were taxed and are still taxed at 50% of the gross gain. A little bit of history on capital gains inclusion rates, though. It was set at 75 in 1990, and then a decade later, the Chrétien government reduced it, first step to 66.67 or 2/3, and they did that in the February 28, 2000 budget, and then further reduced it October 18th to 50%, where it has remained until today. So keep in mind capital moves. Keep in mind that capital is already money that's after paying tax. So and there's a time value to returns. So that's where we're at in terms of history, François.
Yeah. So what are the top marginal tax rates in effect now in Canada?
So after 2015, the federal government added a new top federal income tax bracket, raising the top federal tax rate from 29 to 33% on income over roughly 200,000. This single measure pushed us over the 50% combined top marginal rate. And add to that, many provinces also increased their top rates. So now, to answer your question specifically, where they are at, the rates for 2023, the top marginal income tax rate in Quebec is 53.31%, and in Ontario, 53.53%, and both kick in at income levels of $235,675 of taxable income. Mm-hmm. And I'll share also what's in BC. It's 53.5%, and that starts at $240,716. So we're now well above the 50% psychological threshold, and this is just personal income tax.
So James, how does the Fraser Institute Research Bulletin break out the data for tax paid by all Canadians?
Well, first off, the bulletin reviews the current proportion of taxes that each income group pays. So how does it define income groups? It compares total income earned to total taxes paid. Canadian families are divided into 5 group or quintiles based on their total income, with each group containing 20% of all families in the country. The first quintile consists of the bottom 20% of income earners, and the fifth quintile comprises the top 20%. Although personal income taxes are paid by individuals, the study examines data based on families because individual income is not the best indicator of each person's well-being. So if one person earns over 200,000, but the other spouse earns, 50,000, then really that's a $250,000 household.
Yeah.
So the ranges, and I'm going to quote the top one. So the bottom range is the family income under $59,270. And the top 20% is family income above $243,799. So that sort of gives you an idea of how they break the quintiles or the buckets of Canadians.
Okay, but now what does the Fraser Institute Research Bulletin say about average tax rates for personal income tax paid by all Canadians?
Well, here's the numbers. The bottom 20%. Average tax rate for personal tax is 2.4%. Again, not marginal tax rates, but total average income tax. And the top 20%, it's 24%. Average tax rates represent the total amount of personal income taxes paid by the quintile divided by their total income. And what this research shows is that the average tax rates increase as family income rises, reflecting Canada's progressive personal income tax system. So in terms of the total of personal income taxes paid, the top 20% of income earners pay just under 2/3 or 61.9% of all personal income taxes, while receiving less than half of the country's family income, 45.7%. So in other words, the top income earners are paying about 16 percentage point in tax more than their share of total income.
Okay. Wow. So James, what does the Fraser Institute Research Bulletin say about average total tax rates paid by all Canadians when we include all types of taxes?
Well, all types of taxes. Now think of the GST and the harmonized sales tax as a big one. So the bottom quintile is now paying 18.5% for total taxes paid, and the top 20% are paying 54.2%. So average tax rates for total taxes paid by income group covering all Canadian taxes tells really the same story that we had based on just the personal income tax. So the Fraser Institute research calculates the total amount of taxes paid by quintile divided by their personal income. So again, similar methodology. And as I said, similar to personal income taxes, the research shows that average tax rates rise as family income increases. The bottom 20% of income earning families pays an average tax rate, as I said, of 18.5%, while the top 20%, 54.2%, over half of their income to taxes.
Yeah. So now, James, what are the fiscal challenges going forward for the federal government with the aging population?
Well, it's not just the aging population. With the pandemic, government was giving all kinds of fiscal and financial support to Canadians in need. But now the really big challenge is the sustainability of the old age security. So unlike the Canada Pension Plan and the Quebec Pension Plan, those plans are funded. Old age security is pay as you go. And many experts now feel it is under threat as our population ages. And François, now this is staggering, but the old age security cost for the federal government in 2022 was $69 billion. That's a huge number. But get ready for this. In only 5 years, it is projected to cost $96 billion. So that's $27 billion increase. And it's as large as the entire budget for employment insurance or the Canada Child Benefit. There's no escape from the fact that old age security costs are rising faster than other policy measures in the federal budget. Unfortunately, tax revenues can't keep pace with these rising costs of old age security. So again, it's going to represent a really big challenge for government deficits going forward.
Yeah, totally. Professor Paul Kershaw of UBC wrote an article recently in the Globe and Mail where he stated, and I quote, "The federal government is forecasting $132 billion in deficit projected over the next 5 years. Fully 84% of those deficits can be accounted by increases in OAS spending, along with more money for medical care used by those over the age of 64. This is going to put added pressure on the federal government to generate more revenues or cut benefits."
Well, François, in this year's federal budget, lo and behold, they decided to come up with new rules concerning alternative minimum tax, or AMT as it's known under its acronym. So these new rules are introduced. AMT is very technical, so most Canadians are not aware of how this will impact them.
So what are the change schemes?
Well, in the federal budget, the government proposed increasing the alternative minimum tax rate to 20.5%, up from 15% under the existing AMT regime. The AMT exemption level would increase dramatically to an estimated $173,000 and then indexed annually. So they're really targeting high earners. From what was before a fixed $40,000 number when the concepts were first introduced in the early 1990s. The changes are meant to take effect, as of January 1, 2024. And it said that Ottawa hopes the changes will ensure the highest earners cannot combine certain incentives in the Income Tax Act, including the donation tax credit, to drive their tax rate below a minimum rate. The AMT proposals are expected to affect very few taxpayers, according to the federal authorities, and that's due in large part to that significant increase in the basic exemption amount.
Yeah, I've read, James, that many tax practitioners say that the federal government's proposed new alternative minimum tax, the AMT regime, may discourage philanthropy by punishing people who make large charitable donations. Is that correct?
Yes, it is, and I've heard that from many tax professionals we work with. Among proposed changes, only half of the donation tax credit could be applied against the alternative minimum tax, down from 100% under the current rules. Meanwhile, 30% of capital gains on the donation of publicly listed securities will now be included in what's technically called adjusted taxable income for AMT. These highly technical rules are going to materially impact Canadians who are making very large charitable donations of stocks with large capital gains. Many charitable organizations are making representations to the federal government on how this will negatively impact them. We will discuss these changes in more detail in our next podcast when we'll address the year-end tax planning.
Yeah, AMT rules are indeed very technical and beyond the scope of most taxpayers.
So we know the government authorities are really worried about how the finances are going forward, but we can see by the financial pressures that they're going to try whatever they can to raise revenues on the high earners, because they're the easy target. I will now wrap this topic up, François. The Fraser Institute Research Bulletin, however, demonstrates clearly that top income earners in Canada actually pay a very large amount of tax and a disproportionate share of income tax relative to other income groups. So, the statement that they're not paying their fair share, I don't think is accurate in general terms. And again, it's primarily due to the progressive nature of the country's personal income tax system. Indeed, the current share of taxes paid by high income earners generally exceeds their collective share of income.
Right. As I said at the outset, this is a hot topic for many Canadian high-income earners, and we certainly hope that our government will be very thoughtful in how they plan changes to future tax policies. So thank you, James. Thank you for sharing your thoughts and expertise.
My pleasure, François.
That's it for episode number 57 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on November 23rd. See you soon.